This video lecture deals with monetary policy, the other tool or tool bag that the federal government has at its disposal to impact the economy. Monetary policy primarily deals with interest rates, raising or lowering them, or the money supply itself, increasing or decreasing the money supply. Imagine you went to a bank and the lending officer said, "We have no money to lend." That would not help the economy grow. In fact, it would be just the opposite. You might have been getting ready to expand your business or getting a car loan or a home mortgage, and if the bank had no money they were allowed to lend, the economy would be slowing down. And vice versa. If you went to a bank hoping to get a loan and the loan officer welcomes you with open arms and says, "We'll do whatever we need to do to help you get this loan," that makes you think that there's plenty of money, lendable money in the economy. The Federal Reserve could increase the money supply. So controlling what I refer to as lendable, spendable money, which the Federal Reserve has control over, can definitely impact economic growth. Let's take an example specifically of how the Federal Reserve can impact business investment. If you remember from the GDP formula from an earlier video, I represents business investment in new delivery trucks, in new equipment, in new computer systems, in new buildings, significant new investment by businesses. Well, most businesses don't have lots of money lying around in their checking account or a savings account. Why? Because it's earning nothing. This implies that most businesses, when they make a major investment, will frequently borrow money. Nothing unusual. Let's say that current interest rates to borrow money are 10%, and you as a business manager have a new investment opportunity, maybe launching a new product line or opening up a new sales office or some new productivity enhancing equipment. And that new investment, the financial department has calculated, will yield an 8% return. As a business manager, what will you do? You're going to take money out of your pocket, 10% interest, for the privilege of putting 8% in. Not a good business decision. On the other hand, what if the Federal Reserve, by affecting interest rates, cause interest rates to be lower? And I'm taking an extreme amount. Let's say interest rates are only 5%. You still have the same new investment idea to consider, which has an 8% return. Anything wrong with borrowing money at 5% in order to generate a return of 8%? That, in fact, is what many, many businesses routinely do. Borrow at a low interest rate in order to generate a higher return. In fact, this is one of the reasons the Federal Reserve has kept interest rates so very, very low for going on 6 or 7 years. Only recently, in early 2017, have they begun raising interest rates. There's two ways the Federal Reserve can affect the money supply, the amount of what I call lendable, spendable money in the economy. One is by changing the required reserve ratio, and the other is through what's called open market transactions. The predominant method they use is the second one. Very rarely will they actually change the required reserve ratio, even though that might be the easier one to understand. More likely, they're going to increase or decrease the amount of reserves a bank has, which means the amount of money they can lend. More often, the Federal Reserve will increase or decrease the reserves a bank has by buying or selling billions of dollars of treasury bills with the banks. And they can affect the money supply through what are called these open market transactions. One more note on this short video. Let's talk about interest rates for a second. You've probably heard the term prime rate. The prime rate of interest is what your bank will charge the most creditworthy customer. If Bill Gates, one of the richest people in America, went in to get a car loan he would be charged the prime rate of interest. If you or I went into the bank to get a car loan, we wouldn't pay the prime rate. We might pay prime plus 1, prime plus 2. If we had a lousy credit rating, we might pay prime rate plus 3%. So that's the meaning of the prime rate. The federal funds rate is the key rate to understand when interest rates are actually changing. When you hear in the news that the Federal Reserve raised interest rates an eighth or lowered them a quarter or whatever they may be doing, the rate they are adjusting is called the federal funds rate. Let's talk about this for a second. It's also called the overnight lending rate. At the close of business every day at every bank in America, the bank is required to do a calculation. They have to calculate their required reserves in the vault. Their required reserves, and they have to calculate the actual reserves in the vault. If their actual reserves are less than the required reserves, the CEO of the bank is going to start sweating bullets. Because by law, by the end of the day, they have to have the required reserves. They have to find a way to replenish their reserves. The most common way is the bank of CEO, let's say, will call up their buddy down the street, the CEO of another bank, and ask him or her, do you have any excess reserves in your vault? Hopefully one of them will say yes. You might have to go to a couple different CEOs of banks to find one with excess reserves, and he'll find one that says yes. That other bank will lend literally for a very short term, that's why it's called the overnight lending rate, will lend the initial bank his excess reserves, which will replenish the first bank's required reserves. The money will be lent typically just overnight at what's called the federal funds rate, which the Federal Reserve dictates. So if the Federal Reserve wanted to increase interest rates on a car loan or a home mortgage that you or I are going to the bank tomorrow to get, and the bank had to pay a higher interest rate to replenish their reserves last night, they're going to pass that higher interest rate on to you or I. And that's how interest rates actually change in the economy. The Federal Reserve changes the federal funds rate, and that gets passed on to you or I. Now, there are cases where the banker whose required reserves are below the excess reserves can't find any other bank that has excess reserves. Now this bank's CEO is really sweating bullets. They have one more place they can go to replenish their required reserves. They will actually go to the Federal Reserve itself. And the Federal Reserve will charge them an interest rate called the discount rate. Don't ask me why it's called the discount rate. Here's a graph. I'm sorry this is somewhat dated, but actually the line doesn't look much different. If I extrapolate this line to 2017, it stays very close to zero. The Federal Reserve has kept interest rates very, very low. Now you might ask, why is the prime rate so much higher than the federal funds rate? That's because the bank has expenses. They may borrow at 0.1%, but they charge Bill Gates 3 or 4%, and they charge you or I 5 or 6%. They need to charge a higher interest rate to pay their expenses and hopefully have some profit left over.